All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Bear with me for just a second. I am just double checking, making sure I get the thumbs up that we are streaming here, as I do not have the alert on my desktop here. We're good. All right, fantastic. All right, welcome back. Market's been open here for about an hour, so let's go out, take a look at the challenge here, and then I wanted to go answer a few questions that have come in over the last week, and some little overdue, but just kind of go through a little bit of Q&A here with some of the things that have been sent over to support and that Michelle has forwarded over to me. So let's start with the challenge. We have two positions on the board: gold and HAL. So let's come in and grab those values. Gold 176, HAL is 92. So let's fill those in. 0.92 at 176. So we're down about 165 on Halliburton, about a little more than 10%, and we're up just fractionally here on GOLD from yesterday's position. Neither stock is close to their time stops or their profit levels or their exit levels, so nothing really to change or to update there with that. So we'll continue to run with these positions here today. Now, we do have plenty of cash for another position, and there's one downside crossover out there right now, and that's Caterpillar. Caterpillar has a downside crossing 3.7, but not a bear signal. On the upside crossover list, we have quite a few. We have 4, 8, 9 right now, and you'll notice a lot of these names are names that were on the downside crossover list yesterday. In fact, almost every single one of these, and we've seen this happen. And it was just one of the reasons. We didn't see a lot of bear signals yesterday. We saw Halliburton trigger bearish, and I went and traded it. But we didn't see GM trigger bearish, EOG, Bank of America, Apple, Vale. We didn't see any of them trigger bearish on the downside crossovers. So I'm very curious to see if we get, a bullish signal on the upside reversals with some of these later this afternoon. Procter & Gamble has a decent chance. Looking at the algorithm, it has a decent chance of triggering. But most of the others, not really. Apple is one that could trigger. I'd love to get into some Apple if possible. We'll see. Most of the runs that it has made, it has just not given a buy signal ahead of that run. So, I've kind of been on the sidelines a lot when it's come to the trending of Apple. So I'd love to get back in if it is going to make another move higher there with it. I think yesterday was a very telling day for Apple. To be able to come out profit warn and revenue warn like that and really see no selling pressure, right? The entirety of the selling was a gap down. That was it. Most of the action yesterday on Apple was to the buy side, and we're seeing that continue on here this morning. All right, so nothing to adjust or change here. For the challenge, we'll continue to hold, as I mentioned, gold and Halliburton, and kind of let these play on out, accordingly. Okay. All right. Now let's go to some of the questions. I'm going to start with the two that came in last night. One was on GOLD and the GOLD position, and asked why I just didn't close the position fully yesterday and wait for the next signals, and why I would push it for a fifth and a sixth average true range. Because in the past, I've talked about the probabilities when it comes to average true ranges, right? We're looking and saying, all right, we have a buy signal. Our probability of moving two average true ranges is high, but the probability of moving a third and a fourth average true range is a little bit lower, and a fifth and a sixth average true range is a little bit lower, right? So why not just take it when the probabilities are smaller that it's going to move two ATRs, right? Which is a very good question, very valid question, and it comes down to preference, but it also comes down to some of the data. If I'm trading Procter and Gamble, right, I'm not going to look for a fifth and sixth and seventh and eighth average true range move. It's not realistic. Historically, just doesn't happen. Right? We just don't see that happen very often, where it just kind of goes on one of those types of runs. Yeah, even something like an Exxon, we don't see that happen very often, where it moves 3, 4, 5, 6 average true ranges, here with it. But there are other stocks where that is not the case. Gold is one of those. This is a stock that can move. I mean, how many average true ranges did it move back here in June and July? Right? If we come in and we just put the average true range here, right? The average true range back here was 35 cents. How many 35-cent intervals did it move up over the course of this run? Right? I mean, we're talking double-digit average true range moves. When we deal with smaller companies and more material companies, commodity companies, the probability of moving 2 average true ranges is significantly higher. And then to continue to go 3 and 4 and 5 and 6 and 6 and 7 is much greater than with Dow stocks or with a Coca-Cola or with a Pepsi or Procter & Gamble or Dollar General, right? And so when it comes to Barrick, the probability of moving another 2 average true ranges is still pretty good, right? Is it as good as the initial? No, it's not. But that's also why I don't have as much money in it, right? We took the position, and we've lopped off a lot of the gains, out of it. Yeah, we still have more money in it than what we put into the original position, but not by much, right? Not by much, and we've pretty much taken most of the gains out. So, we've managed that probability change with an exposure change, and our relative exposure, right? The percentage exposure to the challenge is significantly lower today with GOLD than it was when we first got into the position, right? Yeah, the dollar amount is a little bit more, but when you look at it as a percentage of the challenge, it's a significantly lower number, right? And so that's just kind of the way I've managed it here with it, and said, okay, since we're dealing with a commodity company that has a history many, many times over the years of moving 6, 7, 8, 10, 12 average true ranges, all right, the 5th and the 6th, great. No problem. I won't hesitate to play a 7th and 8th, right? Should things still look good? Let's just say GOLD decides it wants to, what's our target on it now? 2152, right? Let's just say it decides tomorrow it wants to go up to 2152. I will have no problem, doing the same thing, trimming a little bit and holding the rest for another 2 average true range move. Does it mean I'm going to hit the top? No. Right? I'm not looking to hit the top. That's not what the challenge is about. That's not what any of these positions are about, tops and bottoms. If somebody can go out and consistently pick tops and bottoms, great, more power to you. I'd love to learn, right? But, that's not what it's about, because it's just simply unrealistic. And so anyway, that's why gold over something else, right? If this were, a stock, let's say, let's just go to Dollar General, right? To trade this and say, well, you know what, it can move 2 average true ranges, yeah, right? Can it move 4? Yeah, historically shows that it can move 4. Is it going to move more than that? Historically, no. Right, the odds are very slim. It can do it on a gap or something like that, but just to have a normal trending run of that, the probabilities are simply lower. And so we can see that with each individual stock. And when it comes to GOLD, it just has a higher probability of moving 2 average true ranges. Happy to run with that. Okay. But great question. Really, really good question. Next question is also a good one. Yesterday I bought a put on Halliburton while the market vibe was bullish, right? And yeah, the market vibe is bullish. It's 5. It's bullish signal, and has been a bullish signal here most of the month since we saw this switch right back here, into the beginning of the month, right? And so the metrics changed. We saw the market vibe change, and back here in the end of January, we saw the market vibe turn bearish. And I got a bullish signal on EWZ, which is the Brazilian ETF. And it came in right here. Let me mark it up here for you. Came in right here. And I got on video that day, and I showed the signal, and I said, I'm not going to trade it. I'm not going to trade it. Why? Well, the market vibe was bearish. And I had a bullish signal on a bearish market vibe, right? Now, the idea here is this is a market ETF. Is it an S&P market? No, but it's the whole Brazilian market ETF. It's not an individual stock. The market vibe is a market indicator, right? So I have very conflicting things. This isn't an individual stock like Apple or Halliburton or Chevron, right? And I'm not going to use the market vibe to say, well, an individual stock, I'm not going to trade it. But when it comes to EEW or EWW, EEM, EWZ, Brazil, the emerging markets here, if we get a signal that's contrary to the market vibe, what do I know? I know that historically it doesn't work out. It's the odds are not in our favor. And I want positions where the odds are in our favor, right? And so I decided, I'm not going to trade it. I'm not going to, be involved there, right? And I just said, look, I'll give it another day, see what happens. Obviously, it, pushed on down the next day. I said, forget it. And it's moved on lower. But when it comes to individual stocks, market vibe bullish, right? But I have no problem buying Halliburton puts on a bearish signal. That's not that's not something that bothers me in any way, shape, or form when it comes to individual stocks, right? Because we can see individual stocks downward trend while the market's upward moving. And we've seen that, many a time. In this case with Halliburton, so far in the ultra short term, no, it's not paying off. But the market vibe is not a consideration when it comes to the signals for the challenge outside of EWW, EWZ, and EEM, which are the market ETFs there. All right. But great question. All right, great question. Now the last two, they came in. The first two came in last night. The last two came in. Michelle forwarded them over to me a while ago, but I've been slow to getting to them. So let's go take a look. Let's start with the one with the market, and this. There's an idea out there of signals where. If we get the market doing a certain thing, we should get more trading signals. Meaning if the market decides it wants to turn bearish, we should get a lot more bearish signals. Or if the market decides it wants to turn bullish, we should get a lot more bullish signals. Or if the market vibe switches from bull to bear to bull, or bull to neutral, we should start seeing a lot of signals in individual stocks. It's simply a false notion. It's simply a false notion. And when you look at the signals, that come in on any challenge, you can go to the other challenge spreadsheets, and you try to compare it to what the market's doing or a switch in the market vibe or something of that. There's nothing there. There's no correlation there outside of anything different somewhere else. And we talk about the challenge, and what's the idea behind the algorithm challenge is to filter out the market noise, right? There's a lot of noise in the market. And so adding a market indicator into the challenge signals doesn't make much sense, right? It simply doesn't. It's just another noise factor. We're looking at individual stocks. And you know what? If I go buy a call on a stock and the next day the market tanks, my stock's probably going down. So yes, the market is a factor. The market does dictate a little bit, right? But even if we go back to GOLD, if I decide, you know what, Jeff, I'm not getting into the position on GOLD on the bull signal right here. I'm not going to get into it because the chart on gold doesn't look all that great, and the gold miner index is lagging a little bit, and the market looks pretty bullish. If I use those arguments, which are very valid arguments, which are very legit arguments, what do I miss? I miss a huge run, right? I miss a huge run. How's that feel? Right? And so it's just one of those where the algorithm is designed to filter those noise factors out, and we can talk about those factors, right? We can talk about those things and some of the tendencies, but it's just one of those where there are infinite noise factors out there, and when it comes to this idea or this concept of we should get more signals when the market is bullish, or we should get more signals when the market's bearish, it's just not realistic, because many times we've seen this happen, since we started the algorithm challenge. There's something like an Apple. It's driving the market, right? Apple's driving the market. It's pushing the market, but it's not giving us any new signal. It's been on an upward trend. It's not giving us any real entry point to get in or to be involved here with it. Right? Or maybe the challenge wasn't going for that week, and so it triggered then, and now it's just not giving a re-entry, right? And I am working on re-entries, right? There's an element here of a trend like Apple where I'd love to be able to find, nice re-entry point where I'm not reliant on the 3-7 crossover and can continue to ride the trend. That said, I haven't found anything where the probabilities are consistently in my favor. And there's still real-time testing going on and everything else with it. It's probably going to take a lot longer than building the original algorithm, because there's not, something that's, blatantly obvious. And it's also not something where I can use any type of back testing to help me because of, just the general positioning of stocks in a re-entry mode. But, I continue to work on it. I continue to look for it. It's not something I look at and go, well, it's absolutely necessary. But when it comes to this idea of, well, the market's doing this, so we should have more signals, it's one of those things that reliance on the 3-7 crossover basically says, no, that's not the case. In fact, a lot of times we'll see a lot of stocks have the 3-7 crossovers to the upside when the market vibe is still a little bearish, right? And then, boom, we get all these crossovers. We saw it last, June or July, where we got all these crossovers. Market vibe was still bearish. We got the bull signals. We went after them, even though the market vibe was bearish. And 2 days later, the market vibe changed, right? And so it's just one of those where I don't, there's nothing in here where I even track what the market vibe is as these signals come in, or really give a darn what the market's doing when these signals come in outside of EWZ, EEM, and EWW, which are market ETFs. Okay. All right, but great question, and I totally understand the idea behind it. This idea of, hey, market's doing this, we should start to get signals, or the market just turned bearish, we should start to get signals. I get that idea and that mentality. There's just no evidence in any of the data since we've run the challenge live here on Trader Minute to suggest that that is the case. And there's nothing in the development that went into that. There's nothing in the development of the algorithm that was even trying to do that, because I don't think it's very realistic. Right? It's one of those that just teach their own there. All right. Now the last question I'll address here is was asked, Jeff, why not a candlestick challenge? Candlesticks are fun to play. You hear me talk about different candlesticks, from time to time. They seem to work okay. Why not do a challenge where we go out and trade candlesticks? Because candlesticks offer good risk-reward elements for many stocks out there. A very valid question, and something that when over time building the challenge algorithm, I did. I looked at candlesticks. I looked at them a lot. I looked at them in many different ways. Looking at them and saying, well, how can I trade these or whatnot? But there's two issues with it. Okay, two issues. Number one, most candlestick patterns do not give a high probability of success. They do offer a good risk-reward scenario. Right? So when I get on video and I talk about a risk-reward scenario on a stock and I say, hey, you can be a buyer off of, the prior day's low or today's low, it offers a good risk-reward scenario. But most candlestick patterns don't offer overwhelming probabilities. In fact, most candlestick patterns are 50 to 55% accurate. And you say, well, that's not very good, right? That's not all that great. And when you look at the accuracy, it's not talking about the accuracy of a certain magnitude of move, right? It's talking about what it does in the next 3 days. And if you're applying options, not only do you need the direction right, but you need a magnitude of move that's significant enough to move your options. Remember, even in this challenge, what is our time decay cost? $723. If we didn't have options that moved, that cost will increase. That cost is not going to be offset. And so not only do we need a pattern that is going to be accurate, but we need a pattern that has a high probability of movement. And with most candlestick patterns, that just simply isn't the case. Just isn't the case. The probability of high movement after isn't realistic. So then you go, well, let's sort it down to the most accurate of candles, right? Let's turn it down to the island reversals and to, some of the big dragonflies and some of the, ladder bottoms and kicking patterns, that are more accurate. Well, the problem then in those lies with any sort of challenge rhythm, right? So I sort it down. I get the 10 most accurate patterns, and I go and I search for them. But here's the thing. Most days, those patterns aren't going to show up. It's not like I'm just going to be able to magically go out, run a scan, and find any pattern I want on any chart out there and go, okay, this gives me a trade. Doesn't happen, right? It doesn't work that way. We don't see that occur. We do see that occur with some of the lower probability patterns, right? That happen all the time. The Haramis or the Marubozus and different things like that, right? But when it comes to the higher probability ones, we simply do not see them triggering a lot. And in fact, with most stocks, you see it happen once or twice a year, not something where it happens once or twice a week, where you get consistent trading. So if I were to kind of just go down and narrow it down to the highest probability ones, wait for those, there'd be zero rhythm in the challenge. We could potentially go months without a challenge trade. And I don't know about you, but that's pretty boring to me. And when it comes to the challenge, there's a lot in the development that has to do with rhythm, right? That has to do with keeping a decent trading rhythm. I know it's not the rhythm that some people want, right? Some people want, hey, I want to trade every single day or 2 or 3 days every day or something like that. And the rhythm of it is variable, but it is one where it's a consistent rhythm over time, and one that, we get a little bit more in certain areas, a little bit less in certain areas. But over the long term, the signal rhythm is consistent. And that's what we've seen with it. And that was intentionally built into it. And it's one of the reasons why I altered the watch list size, is to maintain that rhythm. But with candlestick patterns, to do that, I have no idea how I would be able to do that or make that consistent with the inconsistency of the patterns. And so you say, well, okay, let's just be very picky. We wait for a big, nice, bullish engulfing like this right here. And man, we have waited 6 weeks. We finally get the pattern. The pattern's there. Let's go after it. Boom. It doesn't work. How's it feel? What, are we going to wait another 6 weeks for that pattern? It just is a... it just sets up for a challenge of zero rhythm, of much more importance on one individual trade, right? Where the challenge now, there is no trade that's going to make or break the challenge. Yes, is gold helping the challenge? You betcha. But it's not going to be the ultimate defining factor of the challenge, right? It's not going to be the ultimate, trade that drives the challenge. And Halliburton, maybe we take a loss on it. Is it going to make or break the challenge? No, it's not. And so the way the challenge is built, it is so that one individual trade doesn't make or break it. Where if we did do candlesticks and we did kind of filter down to the most accurate and very patient, wait for them to happen, well, one or two trades is going to make or break the challenge. I don't really want to be in that position. I don't know that anybody really wants to be in that position. And so, maybe is there a way to do that? There might be that, I haven't come up with or thought about. And if you think of something, shoot it over to me. But, it's just something where from a accuracy, trade rhythm, option application, challenge application standpoint, just simply doesn't make any sense. And doesn't give us what we're driving to get. Right? But great questions and much appreciated. Very much appreciated. Thanks for hopping on. Have yourselves a fantastic day, and I'll be back on with you here this afternoon. Talk to you then.